Hi everyone, my name is Robert Eldridge, and today's video discussion is going to be about index universal life insurance policies. 3 things to know. The first thing you need to do out the gate is use a broker. And the reason why a broker can go out and quote with many different companies. When you use a captive company, what happens is they might not be as competitive as a broker, and the reason why is different companies work better with different situations. So for instance, if you have a higher blood pressure, one company might quote better than another. And the whole reason is for you to save money. And that's one of the reasons why you want to use a broker when you look at these policies. And we don't have home office people breathing down our necks. We try to find out what's best for you in your situation. Pretty easy? Okay, let's move to the next thing. This is the most important. Structured and funded properly. Now you're going to hear some things out there about these things being very expensive, these policies. And they're right, they're different than a term. If you're looking for a death benefit that's larger, buy term, take the extra money and put it into a Roth IRA or something like that if it's $100 or so. And that'll save you money. But what a lot of people don't understand, that the detractors out there, is that we're not solving for death benefit when we're doing this. We're doing this because we want to maximize cash value buildup in a safe manner. How do we do that? Number 1, we solve for an extremely low death benefit. So whatever you're going to put in on a monthly basis, the computer will tell us what the death benefit has to be. So instead of $1 million, maybe it's a couple $100,000. So what does that mean to you? That means more of your money is going to build cash value versus paying for insurance. Okay? Let's say you've got a couple $100 a month and you want to get started. One of the things I'm going to do is to save you money is I'm going to do a level death benefit. And the reason why is because that way more of your money goes to build cash value versus a rising death benefit. Now I have a lot of clients that put $3, $4, $5, $6, $7, $8,000 a month into these. So what do I do for them? That way they don't get in trouble. I do a rising death benefit. That way we stay within the IRS guidelines. The death benefit will always stay above the cash value, and that way there's no issues down the road. Now, let's talk about this as well. When you use a broker, I will tell you one of the most important things that I found out is most brokers or agents that work for insurance companies don't know the answer to this following question. How much is it going to cost you to take out your money? And you think that would be the first thing people would talk about, but by law we don't even have to talk about it. And I think it's kind of underhanded. A lot of companies have a variable rate loan on the back end. So one of the reasons why people buy this is because they can take out the money anytime without paying taxes. So for instance, if I give you a loan, you're not paying taxes on that, right? Same thing with the insurance policy. They'll charge you a fee and then credit back some so you don't have to pay any money. Typically the loan fees go away after 10 years. But within the first 10 years they can be murderous to you. And this is what I'm talking about. They might be 8%. Some of them are variable rates, so they can go up further than that. It's really important to know the policies on the back end. And here's the reason why I get a lot of business from people. Is because theirs might illustrate a lot better on the front end, right? Which means cost you less a month for more benefits and cash value. However, I already know on the back end, the policies that I show when you take the money out aren't going to cost you that money. So again, a lot of the people don't know what the back end is, and that's where I get my business, because I could say, yeah, mine doesn't illustrate as good, and the reason why is because we're doing a fixed rate loan at 1% or 0.5%, and you're not going to have to pay 8% or 6% on your money when it's your money. So you want to really look at that, otherwise this isn't even worth it for you. So that's the cost. Like, what's the cost to you is what I'm getting at. One of the other things that I hear out there from a lot of detractors or on my YouTube videos or on my website is, buy term, invest the difference, I can take away your clients, blah, 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 blah. Again, what I'm solving for is the living benefits, folks. The living benefits, not the death benefit, and that's what Susie Orman and Dave Ramsey don't understand. The living benefits. The living benefits, like your cash value builds up. You have a minimum guarantee and an upside cap. So as that builds up, you can access your money anytime when you need it without any approval. You call the company, they send you the check. No IRS penalties or anything like that, okay? You can take the money to unplanned medical is a big one that people take the money out. College funding for kids. Maybe one of their kids looks like it might go to college, guess what? You can take the money out to help them out. Marriages, help the kids out with marriage or your own. Let's say you need an emergency car because your car blew down, well, or blew up. Well, now you can take the money out for a down payment for a car or to buy a house. Do whatever you want with. It's your money, and that's why it's important to know how much it'll cost to access your money, folks, because you're trying to build it up. The other thing that people use this for is for retirement planning. Tax-free retirement planning, because it's a loan privilege. These are huge, and that's why you do all this stuff, so you can build up cash value in a safe and secure manner, so you can pull the money out if you want for a death benefit. You'll have a death benefit. We'll do a level death benefit at that time, and cash. All right. Again, let's talk about some of the policies. Each year they have a minimum guarantee. The minimum guarantee never changes for the life of the policy. So let's say yours issues with 3. Now the cap can change on the S&P every year on the anniversary date. So it might issue with a 13% cap, it might be 10% cap on renewal or thereabouts. The reason why people like doing these policies is because they like the minimum guarantee, there's no losses, and you have a bigger upside potential with the market without actually being in the market. So let's say you get 5% one year. You're like, okay, 5% is not exciting, but it's something that's not bad. Well, you're not taking into effect inflation. You're not also taking into effect that you're not paying taxes on that money, and you're also not including the years that have gone by that had the market went down. So that 5% might be like a 7 or 8% realized gain when you back out everything. So you got to think about that. These policies are big because of that. So that's how these things work. One of the things I want to do is to say, hey, look, I want to appreciate your time. If you're a broker, give us a call. Maybe we can help you out. If you're a client, we'd like to give you an option to give you a consultation and earn your business. Obviously, we don't work for free, but we will ask for your business and potential business and referrals, okay? Also, before I go, make sure you sign up for the free video course I put together about this. That way you can get emails from me over time. It won't be every single day, maybe once a week about these types of policies. And thanks, folks, for your time today. Bye-bye now.